Everybody making money in the equity markets today. Well, not bonds, and then there is that financial repression. Some perspective. Ken Taubes from Pioneer Group Boston joins us. Ken, remarkable events. When you saw these announcements from Europe, did you change your portfolios any?
No, we were well positioned for this. We've believed for some time, unlike a lot of folks, that they would begin to work towards at least a partial solution and heading in the right direction. Remember, a lot of people thought just a few short weeks ago, that no deal was possible given the 17 disparate governments. But here we are, kind of fittingly moving towards some sort of transaction, and the markets had priced in, frankly, the complete breakdown of Europe, and we're moving in some positive direction, even if there is a lot of details to be worked out.
This chart needs some explanation. Bring it up here. This is one of my favorite charts, folks. It's the great moderation, the lower 10-year yield, and down we go, except this was made a month ago, and I've kept it that way. That series drops down near that blue line or even that yellow line, and that is how savers in this nation are getting crushed. Ken Taubes, are you seeing savers go out and capture higher yields, or are they sitting in cash?
Well, up until the beginning of October, I would say people were sitting in cash because, frankly, the credit markets were under a lot of pressure away from government bonds. Those were the only things seeing any appreciation. Most corporate debt and other debt was actually falling in price. But really, since the early October, we've seen a dramatic shift in investor determination, because I think not just the European situation, but also a realization that the U.S. economy is not in recession, in fact has improved since the second quarter, has moved people a little more in the direction of buying some yield in corporate bonds and other types of assets in the fixed income markets.
What's the fear here? If I buy a 5-year or 6-year, 7-year sovereign, am I going to get burnt? Are you modeling for higher yields once we get through the European breakthrough, once we get through the American slowdown? It seems like it's a dangerous time to be in sovereign paper.
Well, it is. I agree with that, actually. I don't even think you have to forecast rising rates. I think that you can look at the overall inflation rates in the U.S. Year over year is 3.9%. There isn't one single treasury that yields that amount of money. So just by being in treasuries with no yield change over the course of the next few years, you're going to lose purchasing power. You know, our advice is, if the economy continues to move along, even at a fittingly slow pace, corporate earnings will continue to be pretty solid. You can buy high-paying dividend stocks that yield more than the same company's dividends.
Be careful. You
can buy corporate bonds.
Ken, you sound like Bill Gross, and he did that, and his bond portfolio fell apart after he told somebody to buy Procter & Gamble on this show. Here's Paul Ashworth, folks, Capital Economics. A mockery of fears. On today's GDP, we expect GDP growth to average a lackluster 1.5 next year, 2.5 today, below their consensus 3.2. We should be a little disappointed. Where is Pioneer on economic growth, Ken, for next year?
Well, I think we have some sectors of the economy that have continued to struggle and put a damper on GDP growth, like the public sector. And housing isn't a strong contributor. But frankly, I think consumers will be steady contributors to GDP. And I think corporations are certainly in a position to contribute, as are exports. And if we get a little bit of a confidence back in that the economy isn't falling apart, a little more stability in regulatory and policy out of Washington, I think there's a lot of ability for the private sector to take over a little bit here. And by the way, even in today's GDP report, the headline actually wasn't as good as the underlying, because a significant amount of inventories were drawn down. So there's no inventory overhang in this economy. And I think that it's a forecast, again, that we're going to have very weak GDP next year, the same way the forecast for recession by now are falling by the wayside.
Ken Taubes, thank you so much from Pioneer. And that's a very important point, folks. The underlying data underneath that headline, 2.5%, 3.6%, I'm guessing, was real final sales. That's amazing.